Welcome back to another stock market open live stream. Today we have a very special day. Actually, it's not that special. We get University of Michigan at 7 a.m. here, and we just got import-export prices. Import-export prices. There was a lot to unpackage here. Import prices were expected to be negative 0.2. They came in at negative 0.3, which is not a surprise. I'm just thinking of like China exporting deflation, so that wasn't a surprise. Import prices ex petroleum were expected to be positive 0.2, actually came in negative 0.1, again, probably China. And you had a lower revision. So, like, we are importing deflation, whether it's Germany, whether it's China, whether it's just all of them combined. Import prices year over year 0.8, and you did have a small up revision though on the year over year, but the month over month pretty low there. Export prices. Now this was interesting. Export prices month over month. We were expecting export prices month over month to be negative 0.2. We got negative 0.7, which is weird because it's like that means the stuff we're making is going out way cheaper than we expected. We had a downward revision from positive 0.7 to 0.5 in the prior. And then export prices year over year were supposed to come in at positive 1.4. And I don't know if this is a glitch or what, but it's negative 0.7. And I'm like, I don't know. It seems like one heck of a drop there. So anyway, inflationary signals from imports and exports really deflationary. So, worried about leftover inflation. There's deflation in manufacturing. And I mean, we've known this, if like anybody who studies earnings calls, like a lot of us do regularly, we know companies, they're looking for, they're trying to get their customers to sign contracts sooner if you're SaaS businesses, and they're slowing down doing that. They're trying to get more adoption for SaaS products. They're trying to get more customers in the door if you're a restaurant. They're trying to get customers to actually pull the trigger buying stuff if you're, a retailer. It's not like a price-friendly environment. Realistically, every single company's pricing power has already declined substantially and is declining. Probably, you've got leftover pricing at like NVIDIA, obviously, because you still have shortages of chips there. But, I mean, and then you could even argue the airliners, well, not the airliners, the air manufacturers would have some pricing power, DoD, whatever. But then you look valuation. So things get entertaining really fast. So anyway, well, let's see here. Then I found this very interesting. There is a note here. It says SOFR futures are predicting a terminal rate at or below neutral now. Okay, so remember how, I mean, I don't know, maybe you don't remember. It's fine. I'm going to catch you up. So before I read this, I just want to catch you up. So I've previously said that the rates market is expecting cuts through about the middle of next year, and we're pricing to get down to about 3%, maybe 2.8, somewhere in that range. Well, over the last few days, we've seen that pace sort of accelerate of that how many rates we expect to get cut in to start moving up. And my take lately has been that the Fed will almost certainly give us at least the cuts that are expected, if not some degree more to prevent a recession. And if you get some degree more, that's fine. That's good. You get more rate cuts. We want that. And then you prevent a recession. Wonderful. Or you get more rate cuts because you're in a recession. Either way, you're probably getting more rate cuts. And this note here talks about SOFR futures, which is sort of how we look at how many rate cuts are priced in. And they are now predicting a terminal rate, in other words, when the Fed stops, at or below estimates of neutral, which, according to the writers over at Doomberg, strongly suggests that the rates market is about to make a recession its base case, even while the data continues to be consistent with a soft landing. And then now you have rumors of 50 BP coming back. You know, you had, we'll talk more about this at a different time, but you can go through some of the latest Nick T content. And there's basically this belief that this terminal rate falling on a futures basis is a warning that the bond market thinks, hey, if we go 25, all we're doing is making a recession more likely. And I think the Fed is going to be cognizant of that. The problem is the Fed's in a blackout period. You know, they can't talk us to death like they used to. I mean, they always couldn't during these blackout periods, but I just remember, I don't know, I feel like I remember 2022. It just felt like they were always talking us to death. It was crazy. But yeah, this is an interesting one. So let's see what else this note has. Let's see here. Okay, one of the most cited versions is the Lubbock-Williams estimate. The market's expectation of the terminal rate was traded at or below this for some period of time. I don't know what this is. Lubbock. Okay. However, okay. Oh, here it is. Okay, got it. So, and now sits right above the Fed estimate of neutral. In other words, the long-run rate forecast from the summary of economic projections, which we'll be getting at next week's meeting, is going to be where they think maybe neutral will be, like end of next year, the year after that. And when the bond market starts pricing below us, then we start getting into concerns about, why is the bond market pricing that in, right? It's kind of like the inverted yield curve, except you're at that phase where that inverted yield curve becomes recessionary. Which, remember, the inverted yield curve does not become recessionary when it inverts. It becomes recessionary when it disinverts. And what just happened? In fact, I think we just saw it disinvert, like a week or so ago, but I think we're only like 1 point disinverted. I'm most concerned about the day that this goes up to like 50. And it's going to happen fast. Like the day you get some shock. I don't know what it's going to be, but this sucker's going to go to 50 basis points uninverted. And that's when you're, boom, in a recession. Right now, we're actually 7.5 basis points uninverted. Oh my gosh, what is this title? JVLC Capital Inc. I feel like you need LLC in that name too. JVLLC LC Capital Inc. That would flow. Thank you for the $10. Do you think when the rate cut happens, it will be buy the rumor, sell the news? Then the talking heads will talk about rate cuts less and focus on recession fears. That's interesting. Buy the rumor, sell the news. Well, it's very difficult to say. Because we all know rate cuts are coming. It's so forecast. So it's possible that you are getting this sort of by the rumor leading up to it because it's so forecast at this point. And I think we're going to get a dovish Fed. But technically a dovish Fed should be associated with the market going up. But if the market, like what we saw at the beginning of August was a market that's actually extremely concerned with, recession's starting to become a little more likely here. And the market didn't go up on that. The market didn't go up on, we might have to price in a recession. The market, went up on, maybe the unemployment data wasn't that bad. So recession seems to drive the stock market down in expectation, which would be fair because generally in recession, stocks go down. And generally, if the Fed is cutting because of recession, stocks plummet. If the Fed is cutting because of a soft landing, which is very, very rare, stocks take about a month and a bit, and then they go up, which that month and a bit after a rate cut that kind of aligns with the election anyway. So I think if you're going to have a soft landing, I think there's a good chance, or at least a chance, you might know by the election. And, if you want to buy the dip in the volatility in October right after Q3 earnings pain. But it's going to be really tough to know because, I personally lean towards recession more than I lean towards not. So for me, I think that just means everything's overvalued, stocks down, right? So, of course, we've covered bull scenarios as well, which is, important to do. There are very, very good arguments for why things just aren't that bad right now, or why this time is different. Now, I don't like saying this time is different. They do. But, Atlanta Fed Fed GDP looking pretty good. It's suggesting GDP is running at 2.5% in Q3. Now, I still think a lot of that is driven by AI and the lack of layoffs. But again, you could have GDP at 2.5. And the order of operations here, I think, is you could have GDP at 2.5. That's fine. Cool. And you can have no layoffs. Cool. That's not your warning sign. To me, the warning sign is the market has some kind of shock. That shock causes enough damage at companies to where they're like, oh, we really need to cut back. Then you get the cycle of layoffs, and it happens fast. It's like January layoffs, whatever. At a time when everybody's doing it, right? After the seasonal workers leave, everybody just starts laying off in January, and it's sudden. And then all of a sudden, when you have the layoffs, that's when GDP tanks. How's GDP going to tank without the layoffs? You kind of need the layoffs. And the layoffs come when companies start panicking, going, I don't know, which could be bad forecasts in Q3, which we'll know in October for the fourth quarter, or it could be some kind of shock that drives that. So, looking at GDP as a recession indicator, I think is a mistake, especially since they also revised the crap out of this. Look back to '01. We were told, oh, don't worry, GDP's 1.8, GDP's 1.8, GDP's 1.8. Oh my gosh, it was actually negative 0.8. We were in recession all along. So, it's crazy. It's crazy. The data in an environment, when you need it most, when the data is most important, it is least reliable. Sorry. Oh. In a recent video, you said the Fed might pump the market. Would that add to inflation again? No. Yes, by the way, I did say that the Fed might pump the market because the Fed does not want a recession. So a tool of not having a recession is avoiding a market correction, right? Because think about the order that I just laid out is shock or market correction leads to layoffs, which leads to recession. Okay. Well, if you can avoid the market correction by cutting rates more and not seeming worried, then the Fed could pump the market, reduce the odds of a market correction because now the market's up, you increase the wealth effect, and you keep spending.
We are outside the 737 MAX facility here in Renton, Washington. There's no production going on this morning. Why? Because these guys who are usually in working on a 737 are out here picketing. Late last night, the Machinist Union announced that 94.7% of their members who voted rejected the tentative agreement between Boeing and the...
I like how they have a rust barrel. Anyway, Anton, enjoyed your interview with Ross Gerber yesterday. Can you talk about his bullish views on AI? Yeah. I think he's got really good arguments on AI. I still think it's a little overblown. It doesn't really change my opinion. But that's okay. We can have different opinions. He's all in. He's a big fan of AI, and I personally see AI as a stair stepper. Right? It's kind of like, oh wow, that was cool. Wow, now everybody has really good chatbots and really good information search tools, which I agree with, his idea of imagine being able to search into your memory, totally agree. I think it's great. But I think that's just the first step. And I understand they keep coming out with all these new models, and I read them. I read about the OpenAI Strawberry release or whatever, and they're like, oh, it's now going to be able to study its own prompts. And I'm like, yeah, well, I actually kind of think that's stupid, because now it's going to study its own badness. So I'm just jaded. So I think you get a stair step up. Oh my gosh, AI is so cool. That's great. So you build out a bunch of server infrastructure. Then all of a sudden, when we stagnate at that level for a while, which I expect we will, because technological innovation can typically come in stages or phases. You have a lot of innovation, and then you stagnate a bit, then you have a lot of innovation, right? You stair step up. Well, then we're going to have this excess supply of server infrastructure once it is built out. Your NVIDIA price, the chip prices are going to go back to normal. And then you wonder, like, is it going to be like COVID, where the supply chains expanded so heavily and they became so fat, so to speak, but then they lost a lot of weight, so they have all the extra skin. I like to use that analogy, even though it's gross. Now it's really easy for you to fatten up again without having to raise prices for your chips, because you have so much extra supply capabilities that, normal H100 prices or Blackwell prices are going to be like $7 or $8 grand for these chips. And then people are going to be like, what? Man, this was selling for 30, 35K a piece. What the hell, man? Yeah, now go write down your balance sheets, and NVIDIA, good luck trying to grow, when in order to just have flat growth, you're going to have to sell 4 times as many chips just to have the same level of revenue as you previously had, because you're no longer selling these damn things at a massive premium. Oopsies. And as far as Elon selling stock soon, well, yeah, I mean, it's just going to be insult to injury, because I don't know that it's necessarily exigent. But watch, if we go into a recession, he's going to sell a shitload of stock in a recession. So it actually like amplifies, unfortunately, the downside for Tesla, because you go into a recession and advertisers start pulling even more from X. Oh my gosh, the selling's going to be glorious for Elon. It's going to be terrible for anyone else. Bob Kendall doesn't think a recession is coming up. Yeah, hey, respect. I respect the other opinions. Somebody says Verizon just laid off 5,000. Well, did they acquire another company? Sometimes you see these layoffs, and it's like part of an act. What the hell? What the hell, man? What is this? There we go. Verizon layoffs. I purposefully, but just so you know, I purposefully don't watch other finance news content. I pretty much just don't watch other content. Like, I got plenty of stuff to do. I got plenty of kids. I'm way too much. But that's not to say it's bad to watch. I love it. I'll audiobook. I like that. Sometimes I'll actually put like a YouTube playlist on when I'm on a run. But my point is, I purposely try to stay away from watching any kind of other financial news content on social media, because I don't want any of my perspectives on data or the news or what I'm seeing to be influenced by some other person. It's all just supposed to be, wow, okay, I didn't think about it that way. Like, when you come to me, I'm hoping you're like, I didn't think about it that way. It's not to have you do a certain thing. I don't care what you do, but it's just to share insight. And I think the best way to do that is just not by listening to other people, because then everybody starts sounding the same. Verizon to lay off nearly 5,000 employees while writing off close to $2 billion during Q3. I think during Q3 is when I canceled my subscription with them. Sorry. And I hate you, Verizon. So, good job. Verizon is about to make a move that will run, let's see, severance, $1.9 billion. Headcount shrink, 4,800 will leave the telecom giant by next March. See? Q1, man. Q1. Who's the other one that's doing Q1 layoffs? Xbox and Blizzard? Last February, Verizon submitted saying they had 105,000 employees. My goodness. 4.5% reduction in workforce. Which also, remember, like, it sounds like, oh, it's just 3% of a company or whatever, 4% or 5% of a company getting laid off. Okay, well, now take, 4% or whatever of the entire labor force, or honestly just take 1% of the entire labor force. That's 15 million people. Did I do that right? Sorry, it's 1.5 million people. You actually don't need to lay off that many people. Now, all of a sudden, your unemployment rate's 5.2, and now you're knocking on the door of a recession. Let's see here. Earlier this month, oh, they're planning on buying Frontier. But I don't think that's closed yet, did it? Yeah, so there was an acquisition as well, though. I don't know if that's Frontier people. Earlier this month, they said ongoing cost savings will result in no longer using certain offices, while non-strategic portions of certain businesses, while leaving some. No, this doesn't sound like a Frontier reduction. This sounds like a we gotta tighten the belt reduction. Well, you know, I'm gonna start making a running list. Okay, that's what I'm gonna do. Running list of Q1 2025 layoffs. Okay, so we're gonna do Verizon, 4,800 by March 2025, about 4.5%. And then, what was it? Blizzard layoffs. I'm pretty sure that was a Q1er as well. Yeah, 3% of the workforce. That was a good one. Thanks for sharing that. Let's see. Activision, Blizzard. Okay, here we go. Blizzard. Oh, well, I guess it's... No, I'm going to say Blizzard. No, it's Microsoft Gaming. Dude, and Microsoft stock has been great. Slash Blizzard. Laying off 3%, 650, no, 650, 3%. And when are they going to do that? I think it was January. Mm-hmm. 650. New round of eliminations following last year's Blizzard acquisition. I'm pretty sure that one is what I think it is, but I'm having trouble. So I'll get to the bottom of it. And let me look right here. 650 in its gaming division, month after it laid off 1,900 from Activision and Xbox. I'll figure it out. But anyway, so there's that coming. So I want to think about new, like leading ones. Anyway. All right. What do we got over here? So we're already 2 minutes to the bell. This is Adobe stock. It looks like it's about to be down 10%, 9 to 10, which is wild. You've got Tesla down 84 bips. The Qs are down 4. Big deal. Palantir's up 17 basis points. What else? Where's the entertainment? And face. You know, it was up like 5% the day after the Kamala debate. And then it was down 4% yesterday. It's like, man. You know, volatility like that, by the way, is a recessionary tell. Just because it implies people just don't have cash to, you know, actually buy the dip. And then I always get, oh, but you show us why you're silence. No, there's not. Let's get the bell.
Shouldn't be surprised if something happens at Bank of America. This is like where the regulators are, but it's not.
Oh, by the way, either today or Monday or Tuesday, one of these days, if you signed up for actual financial advice over at StockHack, we're going to be booking intro calls to kind of just talk to you about next steps. If you want to learn more about that, go to stockhack.com. Crypto, real estate, stocks, bonds, team of financial advisors. It's consulting. You can see the fees over at stockhack.com. And if you're interested, hit that sign up button. We're really trying to get people as much help as possible. Here we go.
Let's get the opening bell this morning and the CNBC Real-Time Exchange on the big board. It is Citi celebrating Hispanic Heritage Month, and at the NASDAQ celebrating an IPO, MBX Biosciences, focused on the treatment of endocrine and metabolic disorders. Jim, I know you disagree with the nervousness on the consumer, and you have good reason if you listen to RH and some of the charts of cruise line spend today.
I'm so glad you got to RH. Now, this was the victory lap I've been waiting for. With Gary Friedman, they beat the numbers, they raised numbers. You start talking about plans everywhere from Naples, I mean, the beautiful place we're going to go to, David, in L.A., overlooking the water, what they're doing in Europe. The vector, Gary talks about the vector, but what I really loved about this.
Oh, Restoration Hardware's up? How funny. Let me see. Oh my gosh. No, is it? Yeah, it's up 18%. Yeah, that one was selling cheap, I will say. And we talked about that one months ago in the Course Member Live. We're like, man, their valuation is low. I mean, the downside is, like, in a recessionary environment, you know, it's all sucks. But yeah, that's crazy. Okay, so what do we got? Adobe's trying to recover from a 9% hit there. And Walmart up 12 bips. Cool. Bitcoin sitting right above our 57,580 line. Cool. Let's see here. Short triple Qs. S&P. S&P's positive 14. Redfin 4. Qs. Qs are kind of slipping there a little bit, huh? Tesla down 1%. Let me see. Tesla just doesn't like that line up there. The 230 line just gives it such headaches. Let's see here. Nvidia, Microsoft is down 11 basis points. Apple's up 2, 3. Oh, today was the pre-order day. I did not pre-order. I think I've always pre-ordered at the time. That's it. Let's go do it now. No, what we should do is see if the delivery estimates are getting pushed back for it. Pre-order, you know, from your starting point. Let's see here. I think the starting point is 920. Why is this so dumb? Oh, there we go. Okay. Anyway. All right. So, pre-order 16 Max Pro, Desert Titanium, 512. No trade-in. Buy. Connect to a carrier later. No coverage. Oh, okay. Okay. Now delivers October 2nd to 7th, but if I want to pick it up in store, if I want to walk my ass over to the store, I guess I could still get it on 920. But no, I'm not doing it. I'm not doing it. I closed it out. I'm not doing it. Okay, where were we? They got too much crap to do. The last thing I need to do is set up a new frickin' phone. It's a pain in the ass. There's always something that goes wrong. Anyway. Hey, Tesla, look at that U-turn. Just like out of nowhere. So, what is that? 40 bips? 40 bipadudes? Nice. How about the nth of the phase? Oh my gosh, it's straight up. Tesla. Yeah, look at that. It's the green new scam stocks. I just think that's funny. People are so passionate about that. Everything's a scam. Tax cuts, scam. How is Oracle up 6%? Oh my gosh, this is crazy. I actually don't really like them because their balance sheet is totally trash. But yeah, I mean they had excellent earnings. I'll give it to them, but like they're having like another post earnings moon after their post earnings moon. Wow. Almost up 1% on Tesla. The moon has come. The Federal Reserve is going to bump it. The market is working as the Fed expects. I do think they think if they could pump the market, they'll prevent a recession. Wow. Now pricing in a 50% chance, 54% chance of rate cuts of a 50. Greater chance now of a 50 than not. 4% chance of a 50 BP cut now at, what is it, 0635. That's why the market's going up. So, and then, yeah, still sitting at about 2.8 on the terminal futures, sitting at around July of next year. Okay. Well, I'm too tired. Okay. So, you know what that calls for, right? Let's see here.
You got to pump it up, don't you know? Pump it up. You got to pump it up, don't you know? Pump it up. You got to pump it up.
This is J-Pow for you. We're gonna be playing this during the J-Pow event. Well, that's gonna be great. Anyway, all right. Wow. Yeah, these were some nice little. You know, it's like the horses coming out of the gates. Oh, don't I have the horse race here? I'm pretty sure I do. It is like the horses coming out of the gates. I don't know why that one always gets me, along with oh man. All right, what is this? The undercurrent of anxiety about the economy in recent weeks has meant that stocks and bonds stop moving in lockstep, with treasuries reemerging as a buffer from equity losses. Correlation between the two asset classes has flipped negative, which means they're moving in opposite direction. Stock returns are lower by 1% since their peak in mid-July, while bonds have gained nearly 4%. The decoupling may be a sign of what's to come once the Federal Reserve starts lowering rates, which is widely expected next week. The track record on the relationship at the onset of Fed easing cycles is mixed, but suggests a balanced portfolio will likely benefit. Well, gee, yes. There's Nvidia trying to go positive too now. Just buy everything. Fed pump it all to new all-time highs. Bump it. Here we go.
I know that we continue to have talks with them, but I keep emphasizing that the money that they should have put to property is going to military.
By the way, the more stocks go up, they're already undesirable to me. The more these green candles occur, I know people are like, oh, but Kevin, I get such comfort in buying a stock that's green. Yes, I know. Psychology of money. But the more green they go, the less desirable they are. The more downside there is. The more stupid the valuation is. But it's all right. No problem.
Of a boost they get into this rate cutting cycle.
The consumer's huge. The consumer plays a significant role in this economy, and it boils down to, though, if consumers have jobs, they spend. And that's what keeps the economy afloat. Right now, we're seeing wage growth in excess of inflation. And so the sentiment out there is decent. It's not as robust as it's been in previous readings, but we don't see it completely deteriorating because people are working. There are headlines of inflation or headlines of layoffs. However, there's not broad layoffs across the economy. It's small pockets here and there that are catching headlines, but not necessarily detrimental.
And Brooke, quickly, before we let you go, I want to get back to the horse race of these year-end price targets, because the top end of 5,800 places you among the biggest bulls on the sell side right now. We're at the lower end right now on the S&P 500, about 5,600. How confident are you that maybe the S&P 500 can add those additional 200 points by year-end?
Well, we're setting the expectation with our clients for the next 2 months. Fully expect volatility. September, October tend to be poor performing months in the market. On average, over the last 25 years, September, the market's been down about 1.7% on average. So we're setting the expectation near term, there's going to be volatility, but we're going to use that volatility as buying opportunities because when you look at the earnings growth projections going into 2025, they're good. We think big tech earnings growth will be around 18%, and we think the broad market will have earnings growth around 13%. That's more robust than what we saw going into this year. So we think that it's going to be earnings that take us higher, but it might take us 45, 60 days to start to move in that trajectory to get closer to that 5,800 price target.
Brooke, happy Friday to you. That is Brooke May, Evans May, Wealth Managing Partner. We thank you for your time. Now, I want to bring you some breaking news because the Los Angeles Chargers and the Miami Dolphins are among NFL teams mulling private equity deals. Remember, the NFL opened up to the idea of private equity.
I don't care. All right, let's see. Recent rotation out of tech stocks that has investors cheering about a broadening out. May not be much of a shift at all. Investors in the last 2 months have been showing an appetite for other sectors other than tech and AI, especially as the Fed prepares to lower rates. As a result, money flew into other corners of the market, including utilities, real estate, industrial, small caps. Real estate, utilities, and industrials have far outpaced the benchmark since July 11th. Real estate, my friends. I like it a lot. Biggest contributor to gains in real estate over this period has been American Tower, which is seen as one of the key players that will gain from larger AI adoption. Utilities overall have emerged as an AI play as well, given data centers are going to need widespread power, whatever. Okay, rotation has actually caused the death of diversification. All these utilities and industrials and the data centers, they're overly exposed to tech. Not adding stocks uncorrelated leaves investors exposed in case of a major AI downturn. Oh, that's actually hilarious. AI I'm gonna write that down. AI not exposure. And so now so who's this? Landsberg, Bennett, private wealth suggests investors investing in real estate, utilities, and industrials around AI are amplifying their lack of diversification to tech and AI, leaving them more vulnerable to a shock, not less. Oopsies. No, but there's no AI bubble. There won't be a bubble, Kevin. This is the future. The future. Okay. Okay. So, what else is going on? Adobe just keeps slipping. But what about the future? No, Adobe keeps flipping because their software sucks. Sorry, if anybody works at Adobe. I mean, you've seen it all crash on my computer. I just uninstalled it. Now I don't get crashes anymore. It's great. But what's interesting is, I felt so bad. When we had the Millionaire Symposium, I was making jokes about Boeing because like everybody does, and the guy's like, "Hey man, I work at Boeing, bro," and I'm like, "I'm sorry for multiple reasons." Oh, no. It's like, I get it, man. It's just there are a lot of departments at Boeing, okay? It's not all 737 Max. And I'm like, well, yeah, you guys do have the spacecraft. Oh. No, I didn't say that. That's bad. I'm sorry. Alright. So, the BT sizzle is going up. It's a bullish day, so I mean it makes sense. You've got I think these higher likelihoods of more rapid cuts from the Fed are really enthusing markets, but that's what Jay Powell wants because it's going to lower the odds of a recession. It's the ironic tool right now. It's very entertaining. This yes, use the market as a tool to do the bidding for you. I mean, this is crazy. Everything's green. Rocket Mortgage, Small caps, IWM's 1.25, LDI's up 5, Rivian's up. Oh, but the Bitcoin short is up. Okay. Let's see here. Super micro. Every time it goes under 4, it always just seems to get back into 4, huh? Lowe's is. I mean, everything is green right now. Like, how much red is there? I don't think there's much red. Let's go. Restoration Hardware, Redfin, Five Below, Loan Depot, Peloton, Etsy. Look, we have less than 1 page of red right now. That's not sustainable. We almost always. I mean, actually, I don't think there's ever a day we don't have more than 1 page of red. So more stuff will go red here. Especially since half of these are like short ETFs, like, S triple Qs. Or bullish dollar. Well, yeah, if you're bullish rate cuts, you're going to sell the dollar. The dollar. Buy the dollar. That's what a Japanese guy told me once in Manhattan. I'm like, so what are you investing in? Dollar. Oh, okay. Like stocks, or like you gonna buy some real estate with the dollar? No, dollar. Okay. All right. I don't know what else is going on.
Concerned about trying to make the ends meet overall, and they focus on grocery bills. As a matter of fact, about 79% of the folks that we've talked to in our own internal surveys say that pricing of groceries is the most important thing for them, and we take that very seriously. And so we think about how we construct the overall offering to our shoppers. We want to make sure they have access to value and actually the other things that they want that they're most important to them.
Well, appreciate that context. And it's a good point. You think about the most recent CPI reading. It was shelter costs that drove a lot of that inflation. So there's a new, of course, boogeyman out there. But I want to talk about categories, because you look at overall food costs and they barely rose last month. But then you take a look at an index for meats, poultry, fish, eggs. It rose 0.8% in August. So how much dispersion are you seeing when it comes to different categories of food?
There is dispersion always, and the ones you just mentioned are interesting because they're close to agriculture commodities, and so you see these effects of things like macro effects, like weather, like a bird flu, which is actually causing the egg prices to go up right now. You see things like the overall tough weather that was in West Africa driving up cocoa prices pretty dramatically. So staples in my cabinet pantry at home.
Yeah, I think it's funny. Somebody's like, very entertaining for us, very painful for you. People think that like I'm short the market. I don't know how often I need to say like, I'm not short the market. Like, I actually have a lot of exposure to like the mortgage companies that are like skyrocketing right now, and my multi-million-dollar bet's green. And it's been green for a while now. So and today it's going up more, and I expect it to keep going up. I mean, no guarantees, obviously. But I always think that's funny. People are like, oh, well, because you're a bear, you must be short. And therefore, on a green day, haha, you're wrong. It's like, man, so juvenile, so simple. It's like, but that stock's gonna go down, so therefore he's short. Therefore he's mad when they go up. Oh, it's sad.
It's a staple, right? Is that fair to say? When you see prices at this kind of elevated level here, what is that ripple effect? Who has this crowded out?
Yeah, so the cocoa being a staple is absolutely the right thing to say, because it's a critically important item in everyone's diet. So that agriculture community, particularly the one where most of it comes from West Africa, is not fully recovered yet. So that's where you see the continued higher prices there, as they are kind of recovering from a lot of issues driven by the early weather events, but some other events around farming there. So I think that's going to be a while before we get all the way out of that one.
Right, and it's a good reminder, like you said, I mean, there's so many factors you can't control when it comes to bird flu, extreme weather, etc. But we're talking about.
Are we really talking about bird flu? I just wanted to make a map. One sec. Trying to make a map over here. Okay. I think it's important for people to try to visualize this crap. It's all crap anyway. It's all just fugazi numbers. But, you know, fugazi numbers that let you do fun things. All right. So first, the top of the chart is either shock. It'd have to be large. Shock. You know what? Let's call it a sustained. You know, this font is just way too big. You know what? And my handwriting is not the best. So why don't we do this? Here, I could type this way faster. Otherwise, I feel like we'll be here all day long. And I don't want to be here all day long. I got stuff to do. I got 7 children. Number 1. Either. Okay? Either sustained shock or market correction. So we'll call that B. And we'll call that A. Okay? Then 2. Let's see. Well, like stage 0, which is already in the past, right? Pricing power wanes. Okay, we already know that. Pricing power wanes for goods and services, and labor becomes more available. Okay, that's like stage 0. We're already there. We already got that. So then, like, do not pass go, basically. You got to get through the steps. So that's 0. Pricing power wanes for goods and services, and labor becomes more available. Okay. Then either you have a sustained shock or a market correction, which then leads to both of those. Both would lead to stock declines. 3, companies suddenly ramp up cost cutting, layoffs. Okay. Then, only then, when unemployment, let's see. Well, I'll just say not when. I'll just say unemployment exceeds 5%. You could even call it 5.5%. 2% above prior low. Recession has likely. I don't want to say started. Recession is likely underway. And then 5, markets fall through Fed capitulation, right? Which would be your, do I remember these dates? March 2001, February 2008, December 2018, March 2020, and I think we had a 1989 capitulation in there as well. So, right, and then stocks fall, risk assets like bonds and gold rise. And then the key, this is the hard part, okay? This is the hard part. It's not the easy part. It's easy in concept. Okay? Hard part. The hardest part. Switch from bonds, gold to risk assets at Fed capitulation. Okay? That's the hard part. There's your cycle. So, Fed may try to short circuit all this, right? Fed may try to short circuit this at arrow by pumping up the wealth effect to reduce the need for layoffs. All right? Okay. Put the little arrow in. Boom. There you go. Fed put. Fed put. There you go. Look at that. How beautiful is that? That's sexy. That's gonna cost you $5 to screenshot, by the way. Okay? You do not screenshot this without paying me $5. You can hit the little member button on the channel. All right. So now that we have that said, did we finally get some more red? Well, Oracle was up like 6%. Now it's up 2.4. Enphase shot up. It's still holding on to its 2.8. Tesla's right back to its 230 line. Dude, all I did was look away for a few minutes. Let's see here. Somebody's like, you got enough money. Get scammed. Oh, that's it, man. Now I'm going to have to come after you. I saw what you wrote. That's all the proof I need. Oh, jeez. Redfin's going nuts again. Woof. Wow, Amazon's back to 188. Look at that. The last, like, few days have been excellent for the market, by the way. It's just, like, all been up. Again, it just also does make them less desirable, ironically. But, I mean, Etsy. Look how low Etsy's gotten. 2 days ago, it was $50 for Etsy. Wow. You're starting to get some cheap prices. Cheaper. Valuations are coming down. That's nuts. All right, did we get some more red yet? What is this? No, we didn't. Microsoft, Nvidia, barely red. Tesla just went red.
Lost the lead.
Adobe's still down 9.5. That's a pretty great market. Let's see here. Etsy fell off when they started catering to China manufacturers. Scam hack. Scamhack.com. Ask Lauren for the Karopi mug. It's actually right here. It's because I didn't bring it to the kitchen. Look at that. We're now gonna model the Karopi mug. There you go. Look at that. How nice is that? Huh? Another option. Aha! Hey guys! The University of Michigan Consumer Sentiment Report is about to come out. Who gives a shit? Hey, man. Alright. Let's see. I hear a baby. Should we get a baby for sentiment? I don't know if it's bottle time. It might be bottle time. Hold on. Maybe we can get a baby for sentiment. You know, because then like, we'll have good sentiment. Hopefully. Okay, 1 sec. We need a baby. Summer? Ooh. This might be hooked up to a tube. Alright, let's see. That's all you need to say. Not yet. Not yet. Not ready yet. Oh, here comes sentiment. 69 versus 68.5. So sentiment went up. Inflation expectations on the 1 year went down to 2.7 versus the 2.8 that was surveyed, 2.8 prior. 3.1 on the 5 to 10 year. And then we have current conditions, good. And the report's actually, it's actually pretty good, honestly. So, yeah, I don't know why Tesla just gave you a big fat red candle there. And Nvidia just gave you a big fat red candle. It's just like any news is just bad news now. All news is bad news. That's what it is. Everything is just bad. But yeah, I mean, things are a little euphoric right now, we'll say. That's getting a little kooky over here. Things is getting a little kooky dukes. Kooky my dookies. Oh, hey, look who's over here.
News, but shares slumping on weaker guidance. More on what to do with that stock in just a moment. And then Oracle continuing its post-earnings rally, hitting record high after record high. The stock now on pace for its best week since June of last year. Also wanted to hit Moderna because it's also adding to some of the losses this week as JP Morgan downgrades the name to underweight, and a number of other firms cut their price targets after some announcements about R&D cutting yesterday.
Got some consumer sentiment numbers out a moment ago. Let's get to Rick Santelli. Morning, Rick.
Morning, Carl.
Rick.
And indeed, there's some surprises here. If we look at University of Michigan sentiment and the related inflation survey numbers, remember, this is September preliminary. It will change in a couple weeks. 69 on the headline. Better than expected. Much better than 67.9 in the rearview mirror. And that's the best overall level since May of this year.
Good.
If we look at current conditions, 62.9, same scenario. Better than expectations, sequentially higher than 61.3, best level since June of this year. What lies ahead? Expectations, same scenario, 73.0, in the rearview mirror, 72.1, best level since April. Now, the inflation numbers. If we look at the 1 year, it's moderated from 2.8 to 2.7, but the comp remains the same. These are the lowest inflationary 1 year survey levels since December of 2020, just like last month was. Now, here's one surprise. If we look at 5 to 10 year inflation, it kicked up. We were expecting 3%. It's been 3%, 1, 2, 3, 4, 5 months in a row, but now it's 3.1. That would be the highest 5 to 10 year inflation outlook since November of last year. Interest rates, well, it's been an interesting morning for sure, because if you look at the 2 year note yield, it's been falling faster this morning than the 10s, making more steepness in the 2s to 10s curve. Right now, as we sit at 357, it's now down 7 on the day, down 8 on the week, whereas a 10 year note, basically at 366, is virtually unchanged on the day, -1 and -5 basis points on the week. Sarah.
Yeah, so in other words, we're now 8.2 bips inverted. Now, what's interesting is I went to the University of Michigan Consumer Sentiment website. Take a look at this. It literally says, a growing share of both Republicans and Democrats now anticipate a Harris win. Consistent with their divergent views of the implications of a Harris presidency for the economy, partisan gaps in sentiment inched up. All right. So in other words, potentially like Republicans feeling depressed and, you know, Democrats feeling happier. Jeez. It's politics.
The front loading.
Sorry, Donald. You should have prepared more.
Going to be what's happening. And that's still I think the base case, but there are increasingly, well, first of all, a number of Wall Street firms said better to front load, go 50. You've been tracking those. Like there are some that have said
JPM,
that.
Citi, yes, and Claudia Sahm this morning on Squawk.
An increasing number saying, why not just front load? If we want to adjust it and we're worried about the labor market, then go 25. So right now, the odds in the market, 50% that they go 50. After CPI, it was 14%. So the odds have increased as the calls have gotten louder. And I think Dudley is someone influential because he spent so long on the New York Fed. So he said that this morning. There also are signs that the Fed can go. I mean, if you listen to Rodney McMullen, the CEO of Kroger yesterday, talking about the consumer, he pointed to some changes and not just at the low income. Listen.
The customer on a budget is under a lot of strain, and we're even seeing that customer even making more pronounced changes. in terms of when first of the month and when they have money, they would be stocking up, getting bigger packages of product and stuff. Then as you get toward the later part of the month, they would be doing things to stretch their budget in terms of smaller sizes, moving to more to our brand products, those types of things. If the thing that we're starting to see that's a little bit of change is really the middle customer is starting to make some of those changes as well.
The middle income customer making some of those changes. And remember, guys, what Fed Chair Powell said just a few weeks ago at Jackson Hole, it was his last big public comment. He said, and I pulled out the quote for you, "We do not seek or welcome further cooling in labor market conditions." He says it seems unlikely the labor market will be a source of elevated inflationary pressures anytime soon as well. And if they do not seek or welcome any further cooling in labor market conditions, some economists argue, okay, so go bigger. People aren't going to be worried that the Fed is more worried than the market. That's kind of been negated because they get all the same information we get. But then there are others that say, the economy's not in such a bad shape. There's no real urgency to go double. So it's an interesting debate that they're going to have inside the Fed. And all we've gotten from them in terms of commentary on this is that they're open-minded about the size. People like Waller, who lead Powell, it doesn't sound like they've ruled it out, but I'm not sure anyone is advocating for it.
An interesting extra sort of discussion here. Just basically in the last 24 hours, it seems like the Fed is through other channels like text messages or whatever, trying to massage markets towards the 50. This is usually what happens when the Fed has a desire to do something and the market is not pricing it in yet. How far would the market need to fall for mass layoffs trigger the thesis to trigger? I don't know. Certainly sub 430 on the Qs. I think 430 on the Qs is more of a coin toss. And then, somewhere in the neighborhood of sub 4 is probably enough to really have you in it. Yeah, very interesting.
Yes, energy is a big part of that. Energy prices are low. But if you take out energy, it was still a negative number on import prices. It's also something we're watching into the election as well, because with the tariff debate front and center, those import prices could become a problem and more inflationary down the road.
If you were to go 50, still unlikely, of course. Does that mean there's a lot more focus on whether you get another 25 immediately in the next meeting?
Right. So then the question is, do they keep going 50?
Yeah.
Do they take it down to 25? We just don't know. We don't know the cadence of what this rate cutting cycle is going to look like because it's not a normal cycle. They're adjusting. They're not easing into a recession. And that's maybe why the Goldman Sachs chart on stocks is really interesting today. Because, you've been hearing first cut, bad for stocks. Turns out first cut not bad for stocks if we're not going into recession. And most of the time when they are into an easing cycle, there's a recession, and that's when the market and the bottom line sells off. But when it's growth scare or normalization, which you could argue is the kind of environment we're in now, most people don't think we're going to recession, it's actually much better. So it's a funky cycle and setup that we're going into for this Federal Reserve. And there are arguments on both sides of it. It's going to be interesting to hear him.
It will.
And also to see whether he gets the consensus. That's the other thing around the table, if he wants to go 50. By the way, programming note, we've got a rare interview you do not want to miss next hour.
Yeah, he will get consensus before he does anything. That's this is very common for oh, hello, Jack. Hey, is there a child for me? They're all eating? Yeah. Bring one over here so I can feed them here. Should we do it? Should we go bring a child? I'll bring a child. Hold on. We'll get a child. Here, listen to this guy.
Management, target of 5,200. Dale, good to have you.
Thanks, Carl.
Why the caution?
We just think we've front-end loaded a lot of the gains for this year. We do think the Fed has to get going. If they should have went in July, in our opinion. They didn't, right? So now the question about 50 versus 25. Real rates are too high. In fact, if you look at real rates as inflation's come down, they're at the highest point in this Fed tightening cycle that they've been, which are grinding on the consumer, which is what you were talking about before. And the neutral rate, you can debate where our start is and the neutral rate. Let's say it's 3. If they come down 125 basis points this year, you're still at 4 to 4.25. You're still 100 to 125 basis points above the neutral rate. And there's just no reason for them to wait. So we think the delay...
They're just all busy right now. They're all in appointments.
The growth slowdown that's happening live as we speak.
So you think this is going to start to get reflected in earnings?
I do think it's going to start getting reflected in earnings. We already see Q3 numbers coming down to the lower end of their range, right? You've got 5 of the 11 GIC sectors sitting on the lower end of the range. Think about this. Just juxtapose these two things. Show me a time in history where you've gotten 10 plus Fed rate cuts and earnings have grown 15% the following year. Those two things just don't coincide. Something's going to have to give there one way or the other. Either you're going to get the earnings growth, of which you don't need 10 plus interest rate cuts, or you're not going to get the earnings growth and they're going to have to start cutting.
Isn't it your suspicion, though, that we don't get the 10, kind of like we didn't get the 6 in January for the year?
Yes, I think we've, the bond market has tried all the way along here to jawbone the Fed into getting what they want. Okay. The reality is, as we sit here this morning, though, the 3-month to 2-year, not the 2 to 10 year, but the 3-month to 2-year is 135 to 140 basis points inverted still, right? So the short side of the yield curve, which is more signal than noise, the long side's more noise than signal, is telling you the Fed's behind the curve right now.
So playbook then looks like what? You go ultra defensive, or?
No, I think you can still stay with equities, but you're seeing the rotation into more defensive sectors. It's clear, right? I mean, if you take just simply consumer discretionary, which has lagged for some time on a technical and a relative basis, and now tech is starting to lag on a technical and relative basis as well. Those pro-cyclicals, minus some of your energy and industrial and those type of places, are really starting to tell you that things are slowing down quickly. Go back to the labor market conversation, right? I mean, the last 3 months, non-farm payrolls are 116,000 new jobs, right? We know labor is a lagging indicator. The year is 204. Last year was 251. 2022 was 377, right? You can see the breadth of that slowdown happening in real time right in front of your eyes.
So it sounds like you think earnings expectations are too high.
They are too high.
Not Fed expectations. So where are they too high in particular? In the cyclicals?
Yes. They're too high, particularly in the top end loaded tech side of things, we think. So you're going to come in probably this year, Sarah, around 243, 245. Next year's expectations are 270, right? Which gives you the 15% growth. That has to come down. We think that number probably needs to be lower than where it is today.
But did you see this chart I showed of Goldman Sachs? Like, the cuttings usually happens into recession, so that makes sense. But if it happens into normalization and soft landing, then why can't you get earnings growth with Fed cuts?
Oh, let's be clear. You can get earnings growth. We just think it's not 15%, right? It's 15% is a year like we haven't seen in many, many years. So the idea that you're just going to get that in a world where margins are actually starting to roll over, if you look at operating margins, they're actually starting to roll to the negative side. Stocks will treat you well when operating margins are expanding. When they're declining, they won't treat you well historically.
Right. Which is why we're sort of gazing to see if we start to see restructurings, headcount, as corporates try to preserve some of those margins. I guess the only thing I would add is Atlanta Fed's still tracking Q3 2.5.
That's right.
And I think B of A 2.3. I don't know what your tracking is for the quarter.
We think it's probably just under 2, but it's still a healthy quarter, right? We're about ready to shut it down. I just think you need to watch the real-time slowdown in what's actually happening. I mean, so again, consumer expectations came in good this morning. Think about what's happening. You know, we've got 21 of 22 months in a row where manufacturing's been below 50 in contraction, right? You've had 29 months in a row where LAIs are still declining, right? Which we talk about LAIs and the false positive it sends, right? But recession risk, we don't think is the base case, but recession risk is about the data you want to look at, right? And that's, to Sarah's earlier point, that's what makes this cycle so confounding and confusing, right? Is that you can find the narrative and the story wherever you want to find it, right? I think the important thing is watching the data in real time and what's happening. And remember, labor is a lagging indicator. It's not a coincident indicator. It's not a leading indicator, right? So be careful, even though that's...
Jobless claims, though, are not lagging indicators, and they look good.
Jobless claims have been flat for 15 weeks in a row. I mean, essentially flat, minus 1,000.
But the 4-week average is lower than it was in the summer.
Yes, and we know some of that's skewed by immigration and all that other stuff. So again, I think you need to watch what companies are saying, right? They're your best real-time indicator, and they're telling you they need to start thinking about reducing expenses. They need to start probably laying off workers, right? Because they're just not seeing the topside demand growth that they want to see and the pricing power that they had and enjoyed over the last couple of years.
That's a good primer for viewers ahead of next week, Daryl. Thank you. Good to see you, Daryl Cron.
Feel bearish today, Daryl. As we head to break, here's our roadmap for the rest of the hour.
Yeah, that was definitely on the bearish side. This idea again that hey, labor market is a lagging indicator. And the labor market's definitely slowing. You know, maybe 50 is right, and don't expect the earnings growth that you had last year to continue into next year. I mean, oh my goodness, it's going crazy. So yeah, I mean that's all sort of driving these calls right now for okay, yeah, let's get the market rallying and really drive less of a need for layoffs. And I think that's part of the short circuit cycle that the Fed is trying to accomplish now. If they can do it, fantastic. Because I think a recession is net just bad. Okay, where are you going? This is crazy. It's just literally trying to climb on the desk now. Oh dear. Oh dear. Hey, you gotta get your hands off that one. Oh no. Anyway, so yeah. Oh dear. Yeah.
The house hack reeked.
That's funny. Anyway. Okay. Yeah. So I think the Fed is really. Oh yeah. There we go. Really doing their job here, or at least trying to. But anyway, we'll talk more about that a little later. We'll watch to see how long the bullishness goes on. And, hey, you know what? The more it goes up, again, I think the riskier it is for valuations. But that may, who knows, reduce the need for layoffs. So it's actually a good thing. It is bullish for the Fed to go larger to try to stop the recession if they can pull it out, if it's not already too late. Yes. Yes. So let's see if they can pull it off. Anyway, with that said, I'm going to bring LOA and we'll go to our course member live stream and we'll see you all in the next one. Oh no. Oh no. Oh no. Oh no. Oh no. Okay, you ready? Oh no. Here we go. Even though I'm a licensed financial advisor, real estate broker, and becoming a stockbroker, this video is neither personalized financial advice nor real estate advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show should not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purpose of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services which we may benefit from. I personally operate and actively manage the ETF and hold long positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuers other than HouseHack, nor am I presently acting as a market maker. All right, you want to press goodbye? Yeah. Hit that. And Ella, say bye. Bye, Ella, over here. That way.
Say bye, Abba.
That way. Look that way.
Bye.
Bye.